what I want to do with Australian Small Cap Investigator is bring a certain knowledge of how businesses that are small work. And that often involves people with ideas. And the reason I like this side of the market so much is because there's a certain ethos that drives it. Now, say what you want about the Australian political landscape, but at the top level, these massive companies, they're essentially bureaucracies. And they have so many compliance obligations that they can't move quickly. In fact, they're incentivized to not move quickly. So being an American, Australian American, I love the ethos of the smaller side of the market in Australia. And so that's why I'm so excited to, I guess, take over Australian Small Cap Investigator.
I was going to say, when you think about it, though, a small company, I mean, that's the epitome, the ethos of a fat tail investment, if you get it right?
Definitely.
I mean that's when there's complete uncertainty, really. Even if it's like even in some cases, $1 billion market cap company, it can still be a small cap, right? But that is where your private investor has a real edge. I mean, because you don't really get an edge in the bigger end of the market, do you?
No. And having met a lot of these institutional analysts, they work for a big broker, they cover big companies. I think I read the other day, CBA has like 150 analysts on the stock in the market, at least. It could
what
be
are they
more.
reading about?
Well, yeah, it's how are you going to get a handle on where the CBA share price is moving? Well, it's a massive multi-billion-dollar company, 100 plus billion-dollar company. That army of analysts, there's no edge for a retail investor there. So I think with small stocks, you actually it's the last frontier of a fair crack. And I think to get that fair crack, you need a good guide and someone who knows the various. I mean, there are also bad elements to the market, just like there are good and bad people. But my job as the head of Australian Small Cap Investigator will be to sort out the fluff and the trickery from what I think are real companies with real substance trying to do ambitious things in the world, and that's what I intend to do.
Yeah, you mentioned mine site visits and stuff like that, but it's obviously it's a bit broader. But obviously, a big part of the Australian sector is in the resources. But
yeah,
I guess it's not just focused on.
I've been to factories. I've been to an orange juice factory.
Right.
I now know how you need to mix oranges to maximize cash flows.
Right.
Like, this is the granular nature of what I was doing for 4 years.
Yeah.
And, it's serious work and it requires talking to a lot of people. Honestly, sometimes if I see a company, I'll cold call their CEO because they've got their telephone number at the bottom of the announcement. They are waiting for anyone to show interest in these companies because most of the time it's hard getting the story out.
Well, this is what we said actually when you first came on and took over the microcap service. What many people don't realise, you couldn't do that. You talked about CBA. You can't call the CBA CEO, can you?
He's behind a massive wall, and anything he says will be scrutinised. So, I think I like to engage with management. I've been doing it for years. It's important to get a sense of what they're trying to accomplish, and that's a big part of the job. And I love that side of things because, it's not just a balance sheet and a set of operations. There's also, a certain caliber of person that's involved. What's their track record? I like looking into these things because, and we'll get to this in a moment.
Yeah.
Clever Canadian investor Pierre Lassonde, he basically says, I found out that 90% of my resource growth as a gold company was the same 10% of my geologists. So he just backs, if they found it, they'll find it again. So he's got a very focused strategy where, the successful ones, you stick with them. So I try and apply that idea to people with track records. The companies I look at, there's a company I know, the guy's found 2 copper mines. Now, why is he working on a tiny ASX copper company? Well, because he's deep in the scene and he knows this could be the big exit. So, I like backing those companies with people who have a track record as well.
Just to sort of span out from the micro a second, just one question on the bigger picture.
Yeah.
It's a good environment for risk capital at the moment, right?
Absolutely.
I mean, we were laughing earlier, like the orange man in the White House has got his man in the Fed now.
Yeah, that's happened. We were on an ed call.
Yeah.
And we were talking about, is US President Donald Trump going to sack this Fed governor? And we were discussing, is it going to happen? And then I chimed in with, hey guys, it's actually happened. So, it's not the first time something like that has happened while we're actually discussing what will happen. So,
but it's clear of the objective, and that's to decrease rates, which that just sets up the small cap sector for...
And Australia as well, we've got quite a bit of ammo with the RBA cash rate right now.
Yeah.
The Australian government has, probably been a bit lavish with their fiscal spending, but the hard truth is that when the central bank has ammo and things take a downturn, it's the classic bad news is good news, where the financial market and the economy are actually kind of separated from each other, and they operate on different wavelengths. A rip-roaring economy might not be a good time for risk assets, but conversely, decelerating economy can, in Australia, I think, create a great environment for risk assets like small caps and micros. So that shows up in the various benchmarks I use to track ASX micro and small cap sentiment. It's been ticking up for a while. There have been a couple panics. I believe in April there was a panic, and then prior to that there was another little sell-off when Japan's central bank did some weird things. But basically what I'm saying is we're nowhere near the top, is my view. And I think we could be in for a stellar run in the next 6 months to 24 months.
Yeah. Well, let's come back to your bumper issue then. Let's go back into one of the sectors that you're really bullish on. And obviously that's lithium. Now, everyone's going to find out what it's all about. If you're a small cap subscriber, and Alliance members will find out what it's all about. But you call this, and these are your words, the final speculative run before it becomes a boring industrial metal like iron ore. So what do you mean by that statement, Lachy?
Well, you look at the lithium price chart. We see two massive runs.
2016? I remember we covered the first one.
And then the first run, you saw prices rise maybe 300%. But in context, it sent some stock prices rising massively. And then we saw a second, even more epic bull run. And then in between those two lithium winters, I think we're coming out of the second lithium winter. And that third and final run will, lithium is I know Joe Lowry, who I've had dinner in the same room as before. Mr. Lithium, they call him. He's got a great podcast called the Global Lithium Podcast. Now, he knows everything there is about lithium. And he said, look, lithium's not a commodity per se. It's actually a specialty it's a specialty mineral in the sense that you need a certain composition. For it to go in a battery, it's not like iron ore, which is a bulk commodity, where iron ore is basically all the same. It's like wheat. It's like, lean hogs if you're into the commodity world. But what I'm saying is lithium will be heading towards a mainstream status where the volatility in price will decrease.
I mean, that's not to say it won't have corrections, right?
No,
you're not saying that. But
I'm saying the amount of supply we need will create so many mines that it'll sort of standardize the price a bit. The iron ore price, it moves from maybe 180 down to 100. That's a big deal. But lithium price, we're talking about 80x changes in prices.
Yeah.
What I'm saying is that this will be the last time you'll see such a massive difference in the price from peak to trough. It'll start to get boring, like copper. I mean, copper I'm very bullish on. It's had some big price moves. Donald Trump had a tariff and then rescinded part of that tariff. And so you saw the copper price move 25% in the space of, say, a day or two. But that kind of move, it's still small in the context of these lithium runs. And that's why I'm calling it the final run, because like when you think about the volatility in these prices, lithium's going to be boring at some stage. But I think there's an exciting part ahead, and you want to be in ahead of that exciting part. And then you can move away from it because it's too dull for you or whatever. But that's essentially the thesis.
Yeah, and you got obviously 3 stocks attached to it. But you mentioned your thesis, but I've because I know, excuse me, I'm referring to my notes because there's a few things I wanted to ask you about this. Now, your thesis actually heavily relies on humanoid robots and drone swarms, which are going to pop just 1 or 2 of the things that are going to help drive this unprecedented demand. But however, these markets are still largely speculative with with uncertain adoption timelines. So how do you account for the possibility that alternative battery chemistries like
sodium ion,
and what I've written here, or solid state could capture? What can they capture much of this emerging demand before the lithium supply constraints bite?
So one of the things that I think the last 20 years of history of battery chemistry has shown us is that lithium is very hard to substitute. You talk about things like sodium ion. Some of these technologies, there's also vanadium redox batteries. I recall a single mining executive being asked, this is by way of example, he asked him, what do you think about new ways to process nickel? And he says, mate, they haven't changed the way we process nickel for like 50 years. I don't believe it. So I'm not saying I'm skeptical that these sodium ion or vanadium redox batteries don't have a future. It's more so that history has shown us that these battery chemistries, once they become entrenched in supply chain and become the way of doing business, it's actually very hard to displace those as a modus operandi for entire industries. So as much as I like the promise of sodium ion, solid state, and all these other chemistries, it goes back to, I guess, the difficulty it is to swap them out, because we've committed so many resources. The world has spent hundreds of billions of dollars backing. It's like sunk cost almost. Like starting again, it's not an easy like for like swap out. So, and even in those scenarios where there is some substitution, it's very hard, and I'm skeptical, but I'll be following the story closely either way. If there is a risk, there's just too much relying on it. And you mentioned humanoid robots and drones, Woody.
Well, it's the tech side of it, right? Because obviously
militaries are relying on this stuff right now on the battlefield in Ukraine. So we're talking about thousands of drones fighting for every scrap of land. Now, that is an inelastic demand because it's a security imperative that we have these drones. It's a new way of fighting warfare. National security trumps price, ultimately.
And in this scenario, I would just say
is my argument.
Every government in the world is also ramping up their defense.
Southeast Asia, across the board, we're seeing governments put a lot of their defense procurement budget towards drones, which rely on batteries, and those batteries rely on lithium. And once you start putting the numbers together, which I've done in the special issue of the Australian Small Cap Investigator that I'm about to release, it's actually a significant portion of lithium demand. And we're talking about a time frame that is as close as 5 years from now. And as we know, the major names, the lithium price, they start moving well ahead of that demand hitting. We've seen that in the past. So it's not too wild an assumption for me to say that, get positioned before this last major run.
You mentioned also that China controls. This is another. That's the demand side. The other part of it is the supply side, right?
Yeah.
And you mentioned that China controls 60 to 70% of lithium supply and processing.
Yeah.
And Western governments in particular are scrambling for alternatives. But if tensions escalate or if China restricts exports, couldn't lithium prices spike so high that it accelerates the shift to an alternative?
Right. Okay. I see what you're saying there, Woods. So there are two scenarios that play out here. Either, in a crisis, China restricts supply of lithium. Well, then the price becomes basically, it's like force majeure terms. Like, if you have it, it's ours now. So the price is so high, it's like, just give it to us. We have drones. And we need to win this war. So that's sort of one scenario. The other way, suppose the trade tensions ameliorate and aren't as severe. Well, China has effectively been backstopping the financing of lithium supply. They're running effectively unprofitable lithium mines in Zimbabwe, places like this. The West has wisened up to this, and they've realized that it's a strategic imperative. And so we're increasingly seeing organizations like the DOE and the Department of Defense start to fund critical minerals projects in the US and elsewhere. It's a market share game, and the US has finally figured out that they need to at least compete in this market share game. So all three tips in the current or soon to be released ASI, Australian Small Cap Investigator issue sort of play on that theme. Friendly jurisdictions with developed assets, and they're ready to go as soon as financing hits the door. So, that thesis, there's also an investment philosophy behind this, which is about that crafty Canadian I just mentioned.
Right, my next
Pierre
question.
Lassonde.
Well, let's talk about that, because just explain what the Lassonde curve is for those that don't know. I know what it is. I spend a lot of time talking to our gold expert, Brian Chu.
He loves it.
He loves the Lassonde, and it really fits well when you're analysing gold companies. But maybe let's just hear it from your side.
Well, for context here, was Pierre Lassonde, Canadian mining billionaire, mining legend. He was chairman of Newmont, massive gold company. He's been around for decades, so he's seen the commodity cycle boom bust multiple times across multiple commodities. Now, I was lucky enough to see him speak in person at PDAC in Toronto in 2024. The room was packed, and he's just explaining things like how AI will affect mining, electrification, decarbonization, critical minerals. At the time, critical minerals were in the dump. So he loves a style of investing which is essentially contrarian. You find beaten up companies that have great assets that are out of the commodity cycle. So you're buying an inflection point. You're trying to time, it's like buying the dip effectively, because as we know, mining companies, they trade on the commodity price. They're price takers. Brian Chu will tell you all about this. So with the Lassonde curve, there are 2 points you want to enter: pre-discovery or pre-financing. So during that sort of resource expansion phase, there'll be growth, and you're not always going to time it to perfection, but it's sort of it's like a double S shape.
Yep.
So pre-discovery, low valuation, then rise on discovery, then resource expansion, and then, oh crap, we're in the development phase.
And that development phase,
we need money.
We need money, and they're spending a lot, right? So
So and then perhaps the commodity cycle turns against you. So you get a double whammy of, oh crap, this mine's going to cost a lot of money, and oh crap, the lithium price or the gold price or the iron ore price is in the tank. And so you can get stuck in these companies that have just been smashed by this double whammy. But the second wave up in the Lassonde curve is that's the pre-production sort of ramp up phase. Now, what I've done in this issue is I've argued that effectively these lithium companies have done all the hard work. They just need financing. And the rise up the Lassonde curve at that second inflection point, well, if the lithium price rises, as I think it will over the next year, 2 years, it might not be dramatic and might not be instant. I want to be firm about that. But if you can get that second inflection point right with companies that have real assets, world-class assets, that's where things can get very interesting very quickly. So it's about catching them before that financing and final investment decision gets made, and then the market will re-rate them as they go into production. So you need the commodity price to work in your favor, and you need to have underlying assets that are inherently valuable.
And well, according to this,
Lasson's a very smart man.
Well, he is, but also so are you, Lachy. Just reading the pre-draft of that report, I mean, it's really thorough.
It's an interesting
and it looks like the things are lining up for these. Obviously, they're high risk.
Oh, this is small caps in a out of favor commodity. So I know it's a tough sell. Pardon me. I know Aussie punters have been burned relentlessly on lithium stocks. They get in late and they exit late, and that hurts. And so it might be a tough pill to swallow, much like myself right now. So, yeah, look, I know it's a tough sell, but I just want people to hear me out on this because...
I don't think it's a tough sell. I think it's a really compelling report and looking forward to that. Look, as I said, if you're an Aussie small cap investigator subscriber, you can read it now. And if you're an Alliance member, and we'll have some details on it next week if you're not. But I hope this has been a little fascinating insight into the first bumper issue, Lachy. But let's move on to something else, just to